Hi, everyone. Welcome to FOW Asia. I'm Joy Teal, Asia representative of Global Investor Group. Yeah, our next panel will gather leading industry players to discuss China assets, the progress of the two-way capital market opening up. Moderating the panel, I'm delighted to welcome Natasha Shen, the partner of JunHe LLP. Natasha has many years' experiences in providing legal advice and services to foreign financial institutions and institutional investors on Chinese futures and investment funds market. To discuss this topic, Natasha is joined by our panelists from OPIM, JP Morgan Futures, Guotai Junan Futures, Hong Kong Exchange, and Zhengzhou Commodity Exchange. Today, we're not only to hear from our speakers, but also would like to hear from you. So we encourage you to ask questions throughout the session via the Q&A function on your screen. Every session is being recorded and will be available on demand. So now I'd like to hand over to Natasha to get it started. Natasha, over to you.
Thank you, Joy. I'm very nice to moderate this panel, and I'm very delighted to work together with my panelists, who are all my friends, and I'm very happy to see all of you. And we have a very diversifying panelist, and I would give just 1 minute to each panelist, so you can have a quick introduction of yourself and your firm. And I will start from Alvin, and then Rochelle, and Eva, and Santa, and Leo. So maybe start with Alvin. Alvin, please.
Great, thank you. My name's Alvin Fan. I'm the CEO of OP Investment Management. We run probably one of the fastest growing hedge fund platforms in Hong Kong, and we cover mostly Asian focused managers who are looking at building up their track record. We're currently running about 2 billion in assets across 40 managers. And we continue to grow. And so we're pretty excited to be here, as a lot of our strategies in-house and with our third-party partners are very related to the opening of China. Thank you.
Thank you, Alvin. Rochelle?
Yeah, thank you, Natasha. I'm Rochelle, CEO of JP Morgan Futures. JP Morgan has been in China futures industry for about 12 years, starting in 2008. At that time, set up as a joint venture. With the regulatory development, JP Morgan successfully got the CSRC approval to acquire 100% ownership in last year, 2020. We provide access to our global and also our onshore local corporation clients to access China onshore futures markets. We have membership for all 5 exchanges. Our global clients can access China internationalized contract while our overseas intermediary relationship with our affiliate companies. That's a short introduction from me and Alvin. Thanks.
Thank you, Rochelle. Eva?
In recent years, sorry, I just log out and come again.
It's just a 1 minute introduction, but you can speak shorter. I know you must have a lot to talk, but we just give 1 minute to every panelist to introduce yourself and your firm.
Okay. I'm Eva Shen from Guotai Junan Futures and the head of overseas clients development, and I dedicated to service for overseas clients who want to trading in domestic financial market. Yeah.
Thank you, Eva. And also Satyan.
Hi, thank you. Pleasure to be on the panel with many familiar faces. My name is Satyan Patel. I'm from the markets division of the Hong Kong Exchange, specifically within that division from the sales and marketing side, focusing a lot of client development work for our brokers and clearing participants, our custodians, our props market makers, our retail focused clients, and obviously our institutional buy side. We've done a lot of work, obviously, on the mutual market mechanism with China, as well as in the field of derivatives. Thank you.
Thank you. The last one will be Leo.
Thank you, Natasha. Good afternoon, everyone. First of all, many thanks for the invitation of FOW. It's my pleasure to attend this conference and meet you all in this cloud meeting. My name is Leo. I'm in charge of Zhengzhou Commodity Exchange Singapore team. This is the pioneer in China futures market. It provides the trading, clearing, delivery, and relative service for commodity derivatives, including grain, cotton, sugar, purified terephthalic acid, that is PTA, methanol, thermal coal, and etc. Today's topic is China access. I think I will take this opportunity. I'd like to share with you some of my observations and thoughts in this regard. I'm also very pleased to discuss this interesting topic with other distinguished panelists and try to make this discussion a pleasant and rewarding one. Here, I wish this conference every success. Thank you.
Thank you, Leo. We have so diversified panel as we have from the buy side and also the exchange and the broker. I think we definitely could have a wide coverage of topics. So the first topic would be about the access to China. So now you know that we have financial futures and commodity futures. So it seems to me, because I'm a lawyer, it seems to me that the commodity futures market open up is much faster than the equity futures. But I do believe that China is still trying to bring more choices when the foreign investors to get access to China market. So here are some questions to our JP Morgan, Rochelle from JP Morgan, and Eva from Guotai Junan. So from a broker view, you're both international broker and local broker, and you do have a lot of foreign clients. So what are your observations and how your client would evaluate these opportunities, particularly given that we have a very diversified, access channel? Sometimes people will feel a little bit confusion when compare those access routes. So maybe starting from Rochelle and then Eva.
Yeah, thank you, Natasha. Yeah, I think you bring up a very good question. After roughly about 30 years of the market development in China futures market, now it's already have about more than 90 futures and options contract covering a wide range of the commodities and also in the financial sectors. In terms of the access channel, there are 3 channels to access China onshore futures market. One is the WOFE, and the other one is the QFE, and the last one is the internationalized contract. So there are differences for these 3 types of access routes. It really depends on what you need and what your situation. For the first one, the WOFE channel, it's actually required as an onshore set up the legal entity. Under this channel, there's no restriction in terms of which contract you can access. It really depends on your business scope. For the legal relationship, it will be an onshore local documentation, and all your technical connection need to be connected to the onshore infrastructure directly, and all your service team will be from the onshore team. And for the second one, the QFE channel. The QFE channel at the moment is the equity index future already open to QFE, and the QFE updated the QFE regime. It sounds like that it probably will have some regulatory announcement to allow it to participate into the commodity future in the near future. But at the moment, it's not like go live yet. In this channel, the first thing is a QFE license. You have to apply for a QFE license, and also need to appoint a local custodian bank. There is the funding. It will be all the USD funding will need to be converted into CNY, and then CNY funding only for QFE access. And then the last one is the internationalized channel. Under this regime, at the moment, there are 9 contracts, 7 futures contract, and then 2 options contract already available. This is actually open more easy access for global client because they don't need to have an onshore setup. They don't need to have a QD license. An offshore entity, they can access China via 2 model. While the overseas intermediary carry broker model, that's one. And then the other one, they can also do the onshore local documentation. I do see most of the client, they probably go via the overseas intermediary model because it's more easy for them. In terms of the setup, they can leverage their already like well-developed setup to access the global market. In terms of the funding, they can leverage the USD funding to cover their initial margin. And in terms of the legal relationship, they don't need to change. They can just stick on their existing legal agreement. And in terms of services, they're still contacting their existing service point of contact. So, but of course, the international contract has a limitation, only can access these 9 contracts. So I think it really depends on clients' needs. Different clients, they may have their different setup and they have their different needs. So they may pick the different access channel.
Thank you, Rochelle. So Eva, I know you do have lots of foreign clients. Have you observed that many WOFE clients, they would also go through the internationalized products as well as the QD application? What is your observation?
Currently, there are multiple entry routes to access China's onshore markets, and just like Rochelle and Natasha said, WOFE, QFE, and the others. For PFM WOFE, as of July 2021, 31 firms have been approved to set up an onshore PFM WOFE, and until now, all PFM WOFEs have launched more than 100 funds. One of the major challenges for PFM WOFEs is the competition from local asset management players. Local firms have advantages in fundraising, localized operation, and track record. And the second one is about the compliance requirement. Due to the significant difference in laws and regulations, foreign financial institutions will face the compliance challenges. And the third one is the IT system integration. The system infrastructure developed by China's asset management industry is often incompatible with systems used overseas. How to integrate systems and make sure that it adapts to local trading volume and speed remains a challenge for foreign institutions. So how about QFE? One big improvement of the new QFE, just like Rochelle said, is that QFE can engage an affiliated private fund manager, which is controlled by QFE, to provide investment advisory service for the QFE. It incentivized some offshore allocators who have their own PFM WOFE to invest their own onshore private fund and via the QFE channel. Doing so can benefit the international asset managers by better integrating internal sources, such as research, investment, and risk management. This is QFE plus WOFE. It allows investing in private funds and enables overseas group companies to seed their own fund in China. It will greatly boost investor confidence. On one hand, it can drive more overseas capital to participate in China's financial market. On the other hand, it can also solve the PFM WOFE's fundraising difficulties to some extent, giving them more time to attract domestic investors and adapt to local financial market. As of now, we have seen 2 investors, Barings and Azamat, directly made contributions to their PFM WOFE through the QFE channel in order to expand their onshore investment capabilities.
Thank you, Eva. That's really very insightful. So it seems that each of these access route would have their it cannot be a replacement to the other. So maybe all of this would have different, advantages and the things that have need the requirement of, different needs. So things like for some of the big asset managers who want to localize, they may prefer to set up WOFE. But if they are only purely to have some allocation to China, they may go through QFI, or maybe they feel like the easiest way is the internationalized product. Is that conclusion correct? Or Shen and Eva, could you just say agree or disagree?
I agree.
I do agree.
Yeah, so another question is because people are still worried about the timetable. Sometimes people seem to like lose patience because the QFI reform happened last September, end of September. At almost a year. What do you expect that when QFI would be allowed to trade commodity futures? Anyway, I know that in China, the most difficult question is about timetable, but I still want to hear from you, from both of you.
I think I would like to share is that the reason in the last few days, there's a lot of media coverage. CSIC Vice Chair Dr. JunHe mentioned this in a number of occasions. I remember that he mentioned in the China International Finance Annual Forum 2021, he mentioned that the expansion of internationalized contract in the QFI regime. And also this is one of those kind of the top agenda from those state council announced the new reform. I believe that we don't know the exact timing, but it's in the radar of the regulator will be in the near term, in the near future. And I think Leo from exchange side probably can share a little bit insight. Is there any preparation work? Get ready.
Maybe we just guess whether it would be like more than 10 or 20 or 30 will be approved. So maybe we can have a lucky draw. Whether we can but are you still optimistic in terms of this open up and the initial, maybe the number of products that will be opened under the QFI?
Personally, I'm quite optimistic in terms of this development. I think the timing wise, we are looking at months. Yeah, and then the product wise, I think there should be more than 20. If I just counted the international contract already at 9, so if less than 20, what's the meaning for QFI, right?
The good reason. Eva, what do you think?
For my expectation, we think more and more instruments can open to the QFI investor. That's the best solution for all overseas clients. But actually, I think they will step by step to opening up, and we hope it will be open as soon as possible.
Okay, let's wish. So next would be the question about the exchange, and particularly for our Hong Kong exchange and DCE. And maybe the first question is to Leo. The question is, from the, you are the China major commodity exchange. So can you just share your view on the opening up, all the 3 ways and how you would expect that DCE will be doing in this opening process?
Sorry.
Okay. Yeah.
Okay. Thank you, Natasha. Yes. The 4 ways, I think, are very practical for entering China capital market. It also shows the diversity of China's opening up. Connect is applied in security markets. In terms of commodity futures markets, internationalized contracts or products, or so-called the specific variety is the mainstream way. We see some WOFEs, and QFI is still at its preparation stage before launching. to be more specific, specific varieties is the mainstream of opening up. At present, PTA, crude oil, fuel oil, iron ore, palm oil, and other varieties has been available to overseas participants. Taking PTA futures as an example, PTA futures listed at ZCE in December 2006. After its listing, the PTA futures achieved sound performance. More and more participants entered this market. For instance, over 90% of domestic PTA producers and traders, more than 8% polyester producers have participated in. The price setting functions has been expanded. On this basis, PTA futures was opened to overseas participants in November 2018. Up to now, there are more than 400 overseas traders from 19 countries and regions such as Singapore, Australia, New Zealand, United Kingdom, Italy, and China, Hong Kong, accounting for more than 10% of the average daily trading volume. PTA futures not only becomes the benchmark in domestic trade, but also changes the traditional pricing way of upstream and downstream products. And it becomes an important benchmark for international trade. QFE is a relatively mature method, which I think works well in China's securities and stock index futures market. Last September, China released the measures for the administration of domestic securities and futures investment by QFE and RQFE, expanded the investment scope of QFE and RQFE schemes. Qualified investors are allowed to invest in financial futures, commodity futures, and options, etc. In light of this policy, relevant trading exchanges will propose specific types of futures and options and report to the regulatory authority for approval. Yeah, I think as for this, we are trying our best to make good preparations for it, creating favorable conditions for the implementation of this scheme. That's all. Thank you.
Thank you, Leo. I think that's from the Chinese exchange perspective, but Hong Kong exchange, I think the market position of Hong Kong exchange is very unique. You did make a lot of very important progress in terms of open up of China capital market, like those connect regime, and also I think the recent news about MSCI. Index futures. So Satyan, I really want to hear about from your side about the plan, how what are the key areas that Hong Kong exchange will develop, and particularly given the news about the Beijing Stock Exchange and Guangzhou Futures Exchange. What are your views and how this would be going forward in terms of the Hong Kong exchange role?
Yeah, thank you. I think you're right. It's a very unique role that we play. If I just focus on the connect for a moment, the mutual market mechanism between Hong Kong and mainland. If you look at where the connect sits today, northbound we're sitting on roughly 2.5 trillion RMB of assets under custody, and that has grown at a CAGR of over 80% since the end of 2015, and accounts for roughly 70% of all A shares held by foreigners. So from a northbound perspective, Connect arguably has been very successful. Again, from a flow perspective, we're seeing 100 to 150 billion RMB ADT now. Again, only a few years ago, that was less than $50 billion. So from a northbound perspective, certainly very strong. I think from a southbound perspective, also equally strong with the assets under custody that mainlanders have of Hong Kong stocks at roughly 2.4 trillion at the end of July this year. Again, a growth of over 80% CAGR since the end of 2015. And again, now southbound investors represent healthy double-digit percentage contribution to the Hong Kong ADT in 2021 versus prior years. So I think a few key factors are driving that trend. Obviously, at a macro level, China is growing in significance globally. You know, when I last checked, it was 15 to 16% of global GDP, and even during COVID, the economy grew significantly last year. And I think from a capital markets perspective, we're in a unique place to facilitate that. And I think to your point about MSCI, I think the index providers have certainly recognized that. If you look at the weight of China in MSCI EM, that has increased to 38% as at the end of June 2021. That was only 18% in December 2019, so 20 percentage point increase in just over a decade. And potentially that inclusion factor could go up even more as we see the weight of China A in MSCI China now at 13% from zero over the last 3 years. And you know, I think the index providers have looked at a number of factors that have driven this. Obviously, onshore, the level of stock suspensions has been one factor that has improved significantly. The index providers have obviously looked to the connect mechanism, which, you know, I firmly believe complements the QFII and QD mechanisms. Connect obviously focus a lot more on the large and mid caps. That the index providers and the index construction in many cases is governed around connect eligibility. So if you're sitting in mainland today, or sitting in Hong Kong or outside of the mainland today, 78% of all Hong Kong and China market cap is now accessible via the Connect. 78%. So that's a very strong number. And you know, we've variously talked about the importance of hedging tools. I think you touched on the recent announcement about futures. That's certainly something that we've been working on for some time with the regulators. You know, as part of a long, I'd say, continuum of enhancements that, you know, the market has seen with respect to Connect. We've talked a lot about things like RDVP, quotas, and more recently, the eligibility of weighted voting rights securities to be included in the Connect. We've talked about for people trading southbound, the inclusion of biotech pursuant to our enhanced rules. We've added starboard in Shanghai to northbound. So a lot of these changes have been part of an ongoing continuum. And I think that the announcement of the futures, which is the first and only offshore A-share futures contract that has the support of the CSRC and the Chinese government, that we announced a couple of weeks ago, I think goes a long way to potentially bringing more investors into China, or providing those investors with critical hedging tools that they have been missing. So, you know, those futures will commence trading on the 18th of October. And, you know, full credit to MSCI there on providing the market with a very sector balanced, optimized 50 security index that is 97% correlated to the CSI 100, much greater correlation than the existing product that's out there in the market. It complements, you know, the various other access products that we have, again, Stock Connect, ETFs, and various other warrants and structured products that we have. It's almost the missing piece that investors have been looking for to help with their Chinese exposure and to manage that more optimally. So all the focus now with that product is on making sure that there's good liquidity on day one and in the months following the launch, both for the actual outright futures contracts and for the spreads, and therefore to help investors roll their contracts more cost effectively. For US investors, the focus is on getting that critical US CFTC to help that ecosystem. And that's really a very unique role that we play, and it goes to the point about having almost the entire ecosystem now for northbound and to some degree southbound access into Hong Kong. So yeah, I think we're in a very unique position to help that equity markets grow. And can't mention Stock Connect without mentioning Bond Connect. That continues to grow very, very strongly. I think 26 billion ADT in the month of August, up 35% year on year. Many market makers, there's over 2,700 investors in Bond Connect. So I think that's a very unique role that we're playing there as index providers. Also facilitate the inclusion of Chinese bonds, for example, in FTSE Wigby, slated for later this year. So the Hong Kong Exchange, I think, is a good place to continue to help bridge the capital markets of China and the Western world, so to speak.
It's so encouraging to hear what you introduce. It's really, I think sometimes I feel like Hong Kong Exchange is like a flagship of China capital market open up. So it really, thank you for sharing this with us. So the next question would be to the buy side, the only buy side from our panel. Maybe, Alvin, we know that at the buy side, you just get this QFII license, and I think you definitely would use that to help foreign investors to get exposure to China market. So I probably I think the audience would like to hear from your side how you can help them to get access to China market, and particularly I know as from the allocator point of view, maybe it's totally different market from China. So what are the offshore investors' appetite, particularly for different type of Asia strategies? And if you have time, or you can also share some view in terms of the outflow of money, and particularly given the because the recent policies on the outbound investment, I think you definitely can cover both inbound and outbound. So it's a two-way open up. We would wish that you can share some view with us.
Sure. There's a lot to unpack there, I think. When we look at the QFII regime, and Rochelle, I'm really excited to hear that, and I hope I can quote you that we're months away from a launch. I'm literally typing that into my LinkedIn right now. We've been waiting. When you talk about timing and we talk about waiting, it's very much from the buy side. It's about how we position ourselves to get those products ready, and the brokers on the panel fully understand this, because we've been working very, very closely with all of them about getting the framework and the infrastructure from the risk and technology, as well as the managers, set up to access the market. Now, the tricky thing here is that investors only have so much patience, right? They're only going to have their capital waiting around so long. So the pitch that we have to give to them every time that we're saying, okay, it's coming up, it's soon, it's coming up, their question to us is, okay, so when do I need to start liquidating or rebalancing my portfolio and to have this ready for deployment? So I think it's really important that we give this feedback to the regulators, that look, you kind of have to give us a roadmap. You kind of have to show us how far or how short, how much time do we have to prepare, so that we can do our part as market participants. So in terms of the type of access that we're hoping to provide for our allocator friends, most of them are from offshore, from overseas, from Europe, Canada, US as well. The reality is that QFII is still quite foreign, in the sense that you're subjecting yourself to onshore regulation, and that's something that shouldn't be taken lightly. So even though anyone is qualified to really get a QFII license, it could be a proprietary firm, most licensed asset managers will be able to. The reality is that the moment that you apply, you have liability from individuals inside the organization, subjecting yourself to CSRC rules. And remember, in China, any failure to act on these are actually criminal offenses. They're not civil offenses. So it's very, very important that we understand what type of compliance rule sets that we have. So our role is to help sort of smooth and round out that experience for onboarding and getting into the QFII regime, and then working with onshore brokers. Now, there's no secret that with the political system, the political pressure that's happening right now between China and the U.S., a lot of the participants are not entirely comfortable yet taking on fully U.S. persons, and this is the worst kept secret. And the reality is that a lot of capital does actually come from the U.S. So those options for U.S. investors still mean that Hong Kong is an important bridge for them to get access to these instruments, and whether it be through Hong Kong Shanghai Connect, or through swaps, or through futures and instruments listed here in Hong Kong. So I think I'm sort of giving a shameless plug for Hong Kong, and how it's still an incredibly important stepping stone for anyone trying to access China. Now, in terms of our experience, with onshore and offshore investors, let's talk about the appetite for offshore investors coming to China. There's a tremendous amount of alpha onshore in China. If you just look at the data and how the investor behavior and the markets move, most of the managers I speak to are very excited, and a lot of them already have experience in domestic deploying their strategies onshore, and they want to take that strategy and give it to offshore allocators, because and I'm quoting this word for word, it's very much like the commodities markets were 30 years ago in the US, where there's a very free market. And so when you ask me what type of regulation do we have to be concerned about in China, the actual consensus is that there's a lot less regulation in China, because the regulators don't constantly step in to mitigate flows or to control things on a regular basis. It's actually a lot more seldom than in the US. So a lot of our managers are very excited about that. In terms of the type of products, and hopefully they'll expand more than just 9 or 10 markets. There's 77 markets out there. All of them are very, very interesting that you simply cannot get access to offshore. So in terms of the strategy style, active management is what they're looking for. In China, there's a huge skew of performance, those who are more passive and have high volatility, and those that are truly outperformers. So from 50 miles away, if you look at China on average, it's underperforming. But if you actually look at the onshore managers who are doing well, there's a huge skew, and there's some really, really talented managers onshore that we're hoping to help get access for. And we really need the regulators to sort of cooperate with us on this, so that we can do that. In terms of the onshore appetite for offshore, so those who are coming offshore, it was primarily driven by corporates and large institutional investors, but now we're seeing a bifurcation between FCM, sort of financial shops coming out, as well as family offices. So the financial institutional investors coming off are provincial financial institutions, medium-sized municipal institutions are coming off, and looking at yield management, fixed income type, but slowly they're building themselves towards alpha. And that's really, really important, because for the last few decades, they really it's so hard to get that capital offshore. So they're going to protect it with their lives. The problem with that motivation is that it stops them from being competitive. And this is something that, as an organization, a lot of them are internally struggling to modernize themselves, but it's happening. And as that happens, that appetite for, again, the same type of alpha generation offshore is going to be really important. So, having these instruments through, the Hong Kong exchange and through the offshore brokers is going to be super, super important in terms of keeping the wheels, very, very gelled. On a final note, just as where we see the appetite moving forward, there's really two areas that I think are really exciting. One is ESG. ESG is huge on the request list for offshore allocators. So China is very difficult to get. It's very difficult to get data, as in green data. And although a lot of service providers looking at building up that green data set, but while that's happening, this is the best opportunity for onshore managers to take that initiative themselves and to build metrics to show investors how diligent and how sincere they are about building a green portfolio. You don't have to wait for regulators to set that bar. You can take that step and go beyond that. And I think that's what allocators are looking at. And the second is quant. Quant did a very poor job last year because it was Sigma 3, Sigma 4 events. But this year, the quant shops, at least the ones we've been checking for, Asia market neutral, China market neutral, doing very, very well. And some I'm looking at mid to high double digits. So I think that's going to come into flavor in the next year.
Oh, Alvin, you really share a lot of insights and very valuable. And thank you so much. Actually, I fully agree with you regarding how you can narrow the gap between the offshore investor and the China market supplier. And as a lawyer, I have ever said that if one client just come in and they don't have any presence in Hong Kong, I would say maybe they don't know much about China. So I think as a manager based in Hong Kong, you definitely know where is the gap and how to narrow the gap. And I think I'm happy to know that you have already done a lot of work. It seems that you also have a lot of work to do. It's both ways is actually educational work. On one side is offshore, and on the other side is onshore manager, how help them to go overseas. And particularly given the regulation side, I fully agree with you. China's problem is not that they have too many regulations. The problem is sometimes they only have principles and the spirits. They don't have regulations. But now the question back to Rochelle and Eva, and because it's about the futures market, because the new futures law seems to improve the legal regulatory environment. But on one side, the outside China people were looking to what it has brought to the foreign market participants. And I think the brokers would be the first teaching in terms of this new laws or policy trend. So maybe back to Rochelle and Eva, could you share just some observations, not just a purely legal issue, but just from the market perspective? What is your view? Maybe Rochelle first.
Yeah, thanks, Natasha. I think the draft of the futures laws published is really a major milestone in China futures industry. Give a very much more solid legal base to regulate the markets. On the legal side, definitely one very important thing is the CCP status being set in the futures law. And then another very key legal basis is a lot of overseas clients. They are really looking at is the netting and also the effectiveness of the collateral. So with those, it's kind of remove a lot of those concerns from the international player. And I think from the business side, we're very glad to see that the cost for the business, those of the principle of the from the legal front is being written into the draft of the futures law. It governs the overseas exchange if they want to provide the services to the China legal person, what they would require from the high level, and then also governance if a Chinese entity or person they would like to trade the offshore products, and also in terms of the onshore futures broker providing access to onshore person to trade offshore. So we're really exciting to see those new development from the futures law, and particularly on the business development side. Yeah.
Thank you, Rochelle. And Eva?
I think the draft futures law, when it becomes the law, would undoubtedly improve the legal framework of the China's futures market. And at this moment, it's still lacking certain legal provisions that are critical for deeper institutional participation. For example, the draft futures law not only covers the exchange-listed futures market, but also includes OTC derivatives. Importantly, it recognized the concept of a single agreement for OTC derivatives trades and the enforceability of close-out netting in the event of counterparties' bankruptcy. The close-out netting is a key provision of trading agreements, such as those published by NAFMI, SAC, and the ISTA agreement. As in the draft futures law, this is the first time that close-out netting has been recognized at the legislative level in China, and it will go a long way to provide the legal certainty that the OTC market needs to flourish.
So again, in terms of from purely regulatory and compliance perspective, one thing is, do you think that those regulatory and policy risk are still the predominant risks, and whether you think that the current tension between US and China would have any impact on the foreign clients' interest in coming to China?
Okay, as we all know, there are currently 5 futures exchanges in China, and each of them may have different trading policies and rules. For example, the market order type is supported by both CCE and DCE, but not by SHIFT. This kind of nuances in trading rules may also exist in the mature markets. So for investors who want to break into a new market, like the Chinese futures market, they would need to get familiar with the regulations beforehand. The clearer they understand the regulations, the smoother their operations would be. To do so in China's futures market, foreign investors can partner with local experts and leverage their profound resource to help them better adapt to the Chinese market. For example, just approaching to drink Natasha for legal consultation.
Yes, for advertisement for me.
For Thai brokers for brokerage or operating settlement, yes, just find a partner to help you to better understand.
My feeling, I also agree with you. And my feeling, China is still an emerging market. It's not a mature market. So adapting to all these, uncertainties in terms of this, policy risks and the compliance issues is always something that the foreigner need to learn. And the next question would be to the exchange and to our Leo from DCE and also Satyan from Hong Kong Exchange. So anyway, I think maybe you can introduce more about your new plan and some on the pipe or some new products or some initial, to further promote the open up of the market. Maybe Leo and Satyan, you can share your view.
Hey, thank you, Natasha. Yeah, at present, there are 23 commodity futures and 6 options listed by DCE, covering many important fields of the national economy, such as green cotton, edible oil, sugar, fruit, energy, chemicals, textile, metallurgy, building materials, and so on. In the future, DCE will continue to promote the research and development of new products. Yeah, we have our list, such as the 5,000 calories thermal coal. Of course, we have thermal coal, but it's another kind of thermal coal. Yeah, caustic soda, pyroxylene, that is the PX. Yeah, it's the upstream product of PTA. Bottom chip, yeah, it's the downstream product of PTA. Propylene, steel billet, cement, electricity power, chicken, potatoes, sunflower, maybe garlic. Yeah. Providing more and more risk management tools for for the real economy. Yeah, I think that serving the real economy is very important.
Thank you.
As for the opening up, I think CCE will adhere to the philosophy of openness, cooperation, unity, and the win-win man side. Yeah. Further expand the range of specific varieties, carry out the construction of overseas special participation system, steadily promote the two-way opening up of markets and the products, make good preparations for QFA schemes, and deepen pragmatic cooperation with overseas exchanges. At the same time, I think that the ACE will continue to promote the construction of ESUNY global routing platform. ESUNY Information Technology is a wholly owned subsidiary of CCE, focusing on Shanghai, Hong Kong, and Zhengzhou, and also has its branches in Chicago and Singapore. ESUNY has built a global routing network, providing global market trading software, connecting the leading overseas exchanges and the brokers, providing cross-border trading service. At present, over 8% of China futures companies in Hong Kong use this ESUNY service. Yeah. I think this future, VC will continue to provide better service to boost its internationalization. Okay.
Thank you, Leo. Satyan, maybe.
Yeah, I think, look, from a primary market perspective, obviously we changed our listing rules to allow primary, secondary, WVR and biotech companies to list. If you look at that continuum, there have been 14 companies from a secondary market perspective that have come back and listed in Hong Kong, raising around $2 billion. These are the Chinese ADRs that many of you are familiar with, and 6 companies with a WVR structure that have raised around 154 billion. So I think from a primary market perspective, the Hong Kong market continues to grow and evolve. And I made some comments earlier around the interplay between the southbound investors and their ability to access some of those companies. I think from a derivatives perspective, our groundbreaking partnership with MSCI last year that allowed us to list a number of futures and options product, many of which had a Chinese underlying, including MSCI China Free NTR, and China Free options, I think was a very good positive step forward for the evolution of Hong Kong. And as I touched on earlier, absolute groundbreaking announcement around the A-share futures in Hong Kong to trade from 18 October has certainly gathered a lot of investor interest. We've done a lot of one-on-one calls and webinars with clients around this, and the interest is very strong, largely, as I said, because it is very highly correlated to the CSI 300 index. Around 45% in terms of index weighting of the CSI 300 is actually covered by the MSCI China A50 Connect Index. And as many of these, investors look at the growth of the Chinex names, for example, our new index, is 83% correlated to the Chinex index. So, it allows a very nice way for us to actually launch futures off the back of it, and potentially look at other things like ETFs and various other products out there. So I think the product development pipeline is strong. We focus on liquidity and really giving investors choices as to how to express their China exposure in the Hong Kong EX ecosystem.
Oh, thank you, Satyan. And Alvin, I think you, because you are the witness for the two-way open up. So, do you think that there will be a booming for the foreign investor coming to China, and also Chinese managers go overseas, or whether it's just a start of the long-term trend. I also got 2 questions from the audience, maybe, but that is for the broker side. I think, Alvin, you can speak from the buy side, and we'll probably have to close as we only have 1 minute. So maybe Alvin, just to share your view.
Yeah, I think in very short, yes. Once, as it opens up, or it doesn't have to be fully opened up, right? Just give us 20 markets. I think that would be a huge sort of push towards where we need to go. Yeah, there's definitely a lineup of investors, and this is not it's not just from the US, as I mentioned earlier. There's a lot of allocators from Canada and Europe who are waiting to get access here. Those who have been in China before, who already have their QFE, like the larger institutions, they've been around for a very long time. They're already in China. So it's really for the rest of the mid-market to catch up, and those who haven't really quite, taken that step yet. But until then, we have Satyan's team in Hong Kong here to give them that first kick.
Oh, thank you, Alvin. And maybe the Q&A, I see we have 2 minutes for Q&A, and there are 2 questions that the panelists can see in the chat room. So maybe it's for the broker, because one is regarding the DCE's agriculture contracts open to foreigner. The other is about the initial margin. Maybe Eva and Rochelle, would you like to answer them?
Sorry, I couldn't see your question.
Oh, the first question is about, do we know if when the DCE agricultural contracts will be made available to foreign investors? This is question 1. And question 2 is, does the panel have a view on initial margin impact to the international clients entering to the China market? Given the high level of initial margin globally driven by OTC market, is there opportunities to optimize initial margin by cross-product offsetting or any specific benefits offered from China? Maybe Rochelle.
Thanks, Natasha. I think the cost margin offset facility, at the moment, all the exchanges, they're developing those margin saving scheme. And with this new margin saving scheme, it's actually investor their savings some margins if they have related contracts trading, or if they have canvas spread, or they have cost product spread, so they will have margin saving. So in terms of the cost netting, I'm not sure what they are referring to. Are they referring to trading both onshore and offshore to have a cost netting, or the trading both futures against the OTC has a cost netting? If they're referring to those scenario, that my understanding, the current regulation probably is not allowed, as they will be operating in different platform, different legal entity. If they're looking at the margin saving scheme the exchange is developing, yes, it is. But the exchange has did a lot of work to improve the margin saving scheme.
Thank you, Rochelle. And about the first question, the DCE agriculture products, when will be made available to foreign investors? Maybe he will say that when will be the next internationalize the products, the category that will be opened. It is due for the broker, I think. The question is for Eva and Rochelle. But no worry, I think anyway in China the hottest question would be the timetable. So we just now. Okay, so we think, sorry. So thank you.
It's hard to show.
Okay, so thank you so much for all the panelists. I will just back to Joy, and thank you so much for your participation, and thank you for the audience to listening to this panel. Thank you. Back to Joy.
Thank you, Natasha, for moderating the panel. It was very insightful and comprehensive, and well complementing CSRC Ms. Shichen Wang's keynote speech earlier. I also like to thank Alvin, Rochelle, Eva, Satyan, and Leo for sharing your views and experience on latest development of the inbound and outbound access to Chinese capital market. So thank you also to the delegates for sending in your questions and interacting with the panel. We hope you have enjoyed this session and found it informative. So next in a few minutes time at 3:35, Natasha will have a fireside chat with Ms. Yiping Yang, the Associate Director, International Cooperation and Business Development Department of Shanghai International Energy Exchange, INE, which is the subsidiary of Shanghai Futures Exchange, to share more examples of accessing to Chinese futures market. So thereafter, we will have a short break and we'll reconvene at 4 p.m. for the panel discussion on trading and investing while keeping risks in check. So we look forward to seeing you shortly. Thank you again, all the panelists.
Thank you.
Good.
Bye-bye.
Bye-bye.